Welcome to the Educated Homebuyer Live. It is Wednesday. It's the highlight of everyone's week, or some people's work days, end of work days, night shifts. So we're happy that you have chosen to join us here as we go through the data. And I say join us. You're probably noticing that we are a man down this week. Mr. Jeb got an invite to the Angel game tonight. So he was able to take that up, and I think he's taken his family out there to enjoy one of the worst teams in baseball. And we can't even watch Mike Trout since he is on the injured list, which is becoming something of a norm with him. So with that, let's jump into the charts. Just got to get them pulled up here. Jeb gave me all of his charts and all of his notes so we can walk you through that. So starting with weekly available inventory, all of this through Housing Wire and their purchase of Altos Research, 595,000 single family homes unsold on the market currently. That's up 3% for the week, but more importantly, up 37% from last year. You can see it's still kind of inflecting up over that 2023 number, but still not growing quite as quickly as 2022. What does that mean for us Southern Californians? Orange County, 2607. It looks like it ticked up just a little bit week over week. Huntington Beach, 145. It looks like it continues to trend down. So a little bit of an anomaly there. Everywhere seems to have inventory increasing, and for us in Huntington Beach, it just continues to slowly trickle down. Weekly new listings, 72,000 new listings unsold this week, plus another 18,000 that were immediate sales. 90,000 sellers is up from last week. It's a reversal of the trend. So if you look here, we had seen a dip the last few weeks, and had actually seen a projection from Mike Simonson over at Altos that we had seen the high for new listings for the year, but we saw a little inflection point. That's 10% more new sellers than this time last year. What does that mean for home prices? Well, we actually have total home sales contracts pending. We're 404,000, 1.25% more sales than last year. If you've seen, we regularly go over the different numbers come out from the National Association of Realtors. Redfin and Zillow kind of run their stuff. And we've seen an inflection point as rates popped up over the last few months, even though we saw a brief correction, that we are seeing a slowdown and are currently on pace to do a little bit less in sales than last year. So home prices, $400,000 for the median home, median price of homes under contract. That's up 3.9% over last year. If you're here every week, you know that Jeb and I don't really love median price. It reflects changes in affordability. As affordability decreases, you will see people kind of pushed down in the scale in prices. As prices go up, it will trend up. So it's just not the best indicator versus some of the paired sales analysis like the FHFA index, the Case-Shiller index, that we would like to pay a little bit more attention to. That's 4% higher, 3.9% higher than where we were last year. Percent of properties with recent price reductions still continuing to trend up. We're at 34.8% of homes on the market have taken a price cut. It's not a huge number, but you can see of the 8 or 10 years that they track here, it is the highest number. It would be interesting to see which homes are taking those price cuts and by location. Maybe we can dig into that in the coming weeks here. Wanted to kind of shift gears. Or our friend over at Calculated Risk, we're going to get him on here soon. He's just been super busy here into the spring and keeps pushing us off, but he's promised he's going to come on and go through some of the data here. Bill does a great job of tracking this stuff, very analytical and just nonpartisan. He's not tied to the industry and doesn't have a dog in the fight. He was one of the first people to call accurately, not just, hey, these crazy loans in 2006, 2007 are going to lead to a crash, but why and how much and the severity. So we'll get him to go through that. But in his email today, he put out this chart. You guys probably see nominal home prices. Oh my God, look how far we are above the bubble peak. And I did not write down the notes of exactly how high above the bubble peak we are, but that's in nominal house prices. Jeb has thrown out the number that if you had bought a $300,000 house in 2010, just inflation alone, I believe 413 is the number that it would have taken it to. So we have to adjust for inflation. This chart does that. And we are still at an all-time high once we adjust for inflation, but it is nominally higher and it has corrected. So actually I would have to draw that trend line across there. Very marginally higher in terms of real house prices over time using that Case-Shiller 20 market analysis. And when we look at that, we saw a little trend down and now it's trending sideways. I drew this green line onto the chart. Bill did not include that in there. It's a rough and dirty estimate of a long-term trend line to show that historically, going back to 1976, that number has been increasing. It's not a number where we say, hey, we're going to go back to normal, because normal has increased over time. Now, is that to say that it will always going forward? Not necessarily, but it has in the past. So if we continue to trend sideways and that price trend continues to increase, we will get to something more normal in terms of real house prices. But it is true that they are higher than they ever have been, but it's a much smaller spread than what you see if we just look here at nominal house prices. Another look at this, Bill threw the number in there of price to rent ratio. This has normalized here, and not because home prices have dipped, but because rents continue to increase at a higher rate than the home prices have. So a much narrower gap there. So you see a lot of the doom and gloomers, a lot of the crash bros online, they'll take a little piece of information out of context and tell you this has to mean revert, it has to crash, without taking into account the basic economics of supply and demand. But wanted to throw that out there for you guys. Housing affordability, that green downtrend line was the 40-year bull market in interest rates. So despite the fact that homes were going up and going up at a rate greater than inflation, affordability of homes was getting better throughout that time. Obviously, you can see here from 1998 through the bubble in 2007, affordability had gotten worse. What I wanted to point out, that red box there in the middle, that peak never should have happened. That was all because of the loan products that were available at that time. Going to lower credit scores, going lower down payments, no down payment, and most importantly, not documenting income. So when you're measuring affordability, affordability got thrown out the window because anyone could state that they made any amount of money and qualify for homes. So we never should have seen a peak quite as high as we saw there. The important one that we're going to see, the green box I threw over there to the left, that point in time is likely, but we don't know for sure, similar to where the market is right now. In terms of home prices had appreciated, but rates had shot to the moon. That is what had really beaten up affordability. If we see rates moderate even to the 5.5% range, affordability comes back in line and closer to that long-term trend line. So what does this look like over the last 40 years? That downtrend in interest rates, downtrend in affordability improving? Well, it leads to really, really big appreciation over 40 years. So California, 664%. The state of Washington, 828%. I think state of Washington is the winner there at 828%. But most of the West Coast up over 600%. Other areas with more land mass, almost all of the Midwest is more like the low 300s. And you say, oh, why did they lag? Well, they didn't lag. They just didn't quite grow as much as the coastal areas that have greater density and less land available to build. So when we look at that, the important part is to put it into context. What did overall inflation do during that time frame? Inflation up 200%, and home prices were up 300 to 800%, depending on where you are. Household income went up 233%. And if you look back until 2022, affordability continued to increase despite the fact that the price of the asset, the home, was increasing at a much more rapid rate than what household income was. And you say, well, how is that? How is it possible? We talk about people don't really care what their house costs in terms of the price that they pay at closing of what's on the purchase contract. They care what's on the mortgage statement. And with that long downtrend in interest rates and increasing dual income households, which is captured in that household income increasing 233%, we didn't see a problem with affordability, and people were able to continue buying. So I thought that was interesting here. This chart just shows you that's actually all 50 states. Right? It looks like a jumbled mess of yarn there. So it's all 50 states, but it shows over time that it's not a straight run up. Those home prices didn't just go from 0 to up 600%. They had a dip in the early 80s. They had a run up in many states in the later 80s. And then we had obviously the big run up in the early 2000s and a dip and then another run up here. So we can look and say that over the long haul, home prices are going to go up. They're probably going to go up at a rate greater than inflation. I don't think it's going to go up 2x the rate of inflation going forward, because even if rates were to drop significantly, we're still not going to have that tailwind of massively lower interest rates, decreasing interest rates like we saw over the last 40 years. We've seen the most of the benefit of that. So it won't be a straight line going forward, likely to appreciate greater than the rate of inflation, likely not to increase at the same rate that it did over the last 40 years. One of the things I thought this was interesting popped up in one of my newsletters this week: propensity to move in the next year, an implied median tenure of residency. So one of the reasons why we have such low sales of homes, in addition to the lock-in effect from everyone getting these really low interest rates and many younger buyers having their timeline moved up due to the opportunity during COVID when interest rates were so low. Looking here, median tenure is up to about 8 years. And this includes, I believe this includes renters. This is not just owners. And then propensity to move. People are very unlikely to move. I think we're down to what, 3% chance of someone moving in the next year, which is kind of at an all-time low, at least going back to 1948 here on this chart. That has impacts on both sales volume and sales prices going forward. Who is taking out mortgages? You guys often ask us here, who can afford, who's buying? Is only rich people, only old people? Well, this is showing you that under 35 is the largest group of people taking out mortgages. So that's because some of these older people, 55, 65, over 74, they downsize, they pay cash. So less of them taking mortgages, but most people financing their purchases are in that under 35 or the 35 to 44 age group. Now, this one is interesting here because this has flipped. If you look at that red line, that's people 65 years and older. That's the share of consumer spending by age group. When I was growing up, my great-grandparents had been through the Depression. My grandparents were raised by people who had been through the Depression. They were frugal. They took care of things. They owned it for a long time. They weren't just consumers for consumerism's sake. But as they've saved up and accumulated, their children, the baby boomers, are now the greatest consumers. And I don't think it's that they're incredibly less frugal. It's that they've built up a chunk of assets. Now, are they greatly outpacing every other age group? Not really. You look at those other four that are all there within what, 19% to 22% of all consumer spending. So pretty evenly distributed, especially if you consider there's probably, I don't want to say this, but if we looked at the cohort, that 65 and over is probably a little bit larger than those other groups when we look at median lifespan. The only group here lagging is spending among 25 to 34-year-olds. It could be income. It could be just that we have seen a trend among Gen Z millennials of not spending as much money as what older generations have. Thought this was interesting. You guys always like to see measures of inflation. Two measures here. This is the hourly earnings of non-managers in fast food. That's the purple line. So just since 2017, up 35.9%. Fast food meal prices up 41%. Probably capture some of the increases in food prices over that time as well. But either way, it's not a good measure. And one of the things that's interesting about fast food, it's like gas. People complain about inflation when they buy gas because they got to fill up their car once a week, twice a week, a couple times a month. People like to go out to eat, and the easy, fast way is to pull through a drive-through. And when you go, hey, my value meal was $9 and now it's $19, it's not as much of a value. So it's definitely something there that you would see. We have an election coming up. I just thought this was interesting. I don't know that it has much, if anything, to do with housing and real estate. But the median age of global world leaders around the world is 50 or 62. So most global leaders are in their 50s and 60s. So enough time on earth to accumulate experience, knowledge, wisdom, but still young enough to apply that. Well, us here in the United States, we have President Biden at 81, and I meant to write this down, but Trump is no spring chicken. What is he, 74? So not a whole heck of a lot younger. It would be wonderful if we could get someone in that, say, 50 to 65 age group to run the country, but that's not going to be on the menu for this election season. So coming up, we are coming off of about 15 days, at least 10 days of very, very little economic news to move the market. And what we're going to get over the rest of the week is some good data, and then we have more of it coming next week. So yesterday we had a 5-year note auction. It was a very weak auction, led to slightly higher interest rates. 7-year note auction today, also very weak, slightly higher interest rates. Tomorrow we get a look at Q1 GDP. So that's really in the rearview mirror. It shouldn't be a big market mover. That's why it only has one silver star instead of a gold star there. but it could move the market if we got a surprise to the high side or the low side. The important one we're looking at Friday is PCE. PCE is the Fed's preferred measure of inflation, so they will look closely at it. The market has not moved tremendously with this over the last 6, 7, 8, 10 months. Going back to when we first got that really hot CPI read, the market has been trading CPI much more so than PCE, but something that deviates from expectations, either to the good or the bad side, could absolutely move the market. Then next week, we have a payroll report on Friday. It's always the first Friday of every month, and this month, it's the last day of the month falls on this Friday. So we're looking forward a month to Friday. All right. This is the money shot here. We have our chart that we've been looking at, and I should have thrown Jebs in here. We draw them separately, and then we compare notes to see if we're seeing it similarly. And we both kind of always focus on slightly different things in here, despite the fact that we're looking at the same chart and seeing the same data. So we told you a couple weeks ago when we did not get a convincing break out the bottom of this up channel that was problematic. Well, here we are. We've making a run, 70% retracement up to the top of the channel. We do have another Fibonacci level there above us. Hopefully we stop out somewhere around that 465. The data the rest of the week will go a long ways towards telling us if we're going to run all the way to the top of that channel. Looking forward, what is going to happen the rest of the year? What is the Fed going to do? And what basically the Fed is going to be reading the economy, both in terms of inflation, in terms of growth of the economy, and the employment and jobs market. So these are the experts that get paid to do research and put it out for their clients who are investing, both institutional investors and individual investors like you and I. So this was published in the Wall Street Journal. I forgot to give credit there. Nick Timmerhouse over there put this together. I sort of reorganized it because I didn't like the way they did it. But if you look here, the three biggest, or the three that I highlighted there, Morgan Stanley is projecting 75 basis points of cuts between now and the end of the year. Goldman Sachs and Nomura were both at 50. Now, those all came out in the last month. Morgan Stanley on May 7th, Goldman Sachs on May 24th, and Nomura on May 22nd. I don't know what happened. I don't know what's happened here the last week that the market is sort of bearish on interest rates. Bigger picture, we're not massively out of the range of what is to be expected, but we need some good information to move us back in the right direction. But if you look, the vast majority of the middle here, if we put a bell curve on this, 25 to 50 basis points of cuts through the rest of the year expected by all of these major investment analysts. This is interesting. This is a look. I think this is Bloomberg puts out the daily shot. Black line is Fed funds futures expectations for what's going to happen. We started out at the beginning of the year, 6, almost 7 cuts expected. And that's been almost a straight line down to where we are under 2 cuts expected. We look back at this chart here, that falls in line with what most of these people are expecting, 1 to 2 cuts throughout the rest of the year. This is the CME FedWatch tool. It's an aggregated probability. It's a little different than the way I usually show it to you guys. And what this does is tells us at each meeting, what is the greatest likelihood of where we're at. So June, nothing, 98% chance of nothing. July, 89% chance of nothing. 50-50 shot for September. That's before the election. The Fed has said we're not partisan. We will do what is right for the economy. So it is not out of play. It's not in play. The funny thing is they meet again right after the election. So cutting right after the election while not cutting before the election could also be seen as partisan, depending on who wins and if it has any impact on the election results. But we got a 76% chance throughout the rest of the year. So that's really saying one cut, 25% chance of 2 cuts there. And then we start moving into next year, and we're likely to see a couple of cuts by the end of the first quarter based off of the Fed funds futures market. What does all of that mean for you today in terms of interest rates? Up to 7.34 for the most well-qualified borrowers per Mortgage News Daily. Really well-qualified borrowers, we can do a little bit better than that. FHA at 6.85, we can absolutely do better than that. A lot of volatility in their numbers, but that is what we're looking at. We've got over 100 of you here on board. I appreciate that. Without my co-host, me just jibber-jabbering, I kind of like the banter and the back and forth and kind of getting some input from one another, and we don't have that tonight. So I appreciate you guys being here. We've got a couple of folks. M. Finnerty says, hi, Josh. Matthew says, most importantly, hit the like button. So if you guys enjoy me being here and filling in solo without Jeb, make sure we hit the like button so it gets as many likes as when he is here, so he doesn't feel too good about himself that all of the likes are just for Jeb. So we don't have a ton of questions, but let's go ahead and jump in here. Nicholas Cage, a longtime viewer here, says, got to sell my house in Texas, move to California. Don't know where to begin with regard to finding a realtor to sell my house. Any tips? I will say the easiest one is reach out to Jeb. I will put up the link here in where you can get a referral from him. So let's throw that there. That link will get you a referral. What I can tell you is Jeb is in a couple of high-level networking groups of excellent realtors. When I'm working with a borrower and they ask for a referral and Jeb sends them out to someone around the country, I can assure you I have never had a bad experience with any of them. The worst of those realtors is very, very good. So that's sort of an easy button. So a little pitch. If you want to get connected with a mortgage lender, any of the 18 states where our team can help you, that will get you through to me. If it's any of the other states, we have pros that are vetted and also excellent that can help you anywhere. But specifically to this, it is important. Texas is a very big state. I don't know if you're in a big metro like Houston or DFW. Big metro, we got lots of realtors to choose from. You get out to some of the more rural areas, it can be more difficult. It's like anything else. You want to talk to at least two to have a point of comparison. Much like on mortgages, you need to have a relationship and a rapport with that person. They're going to be in your house. You're going to spend time with them. They're going to be helping you negotiate. They need to get to know you, your goals and objectives, what's most important to most effectively represent you. So make sure you connect with them. Make sure they have the knowledge and skills that you need, both of your local market and just real estate in general. So again, the easy button, have Jeb connect you with at least one to interview, and then see if you have any friends, family, coworkers that have someone local to your area. And they don't have to be a top producer, but I wouldn't use a rookie or someone that's semi-retired and not doing a lot of business. I want a full-time realtor that is doing this as their day job, as their only job, and being able to fully represent you. So along the same topic, T. Yat says, Josh, you legally able to be my mortgage broker in Las Vegas? Las Vegas is one of the very few areas that our company is not set up to help. In the entire state of Nevada, Nevada has some very strict brick and mortar requirements. Many states that even have a brick and mortar, you just have an office, which you can set up an office suite somewhere, and you don't have to have a full-time employee in the state. You just have to have an office place of business. Nevada requires a full-time employee that manages that branch in the state, and we've just had a hard time finding the right person there. We are hopeful that it will happen at some point this year, but as of today, we cannot help. I do have two excellent mortgage brokers in the state of Nevada who could help you if you don't have anyone else here. So D-Sonic says, J5672. I think we went through these numbers last week. Was that you? I believe it was. But HB and Irvine made the top 10 list of best places to raise a family. Both of them are very, very good places to raise a family. Nowhere is perfect. Irvine has super highly rated schools, some of the best parks. It is probably the most highly planned community in California, if not one of the most highly planned throughout the country. So you have green belts, open spaces, great schools. People love it, and you pay a premium for it. Huntington is one of the cheapest beach communities in California, Southern California specifically. So we have some high-end stuff. We've got $5, $6, $7 million houses that face the ocean that are in the harbor, but you still can get a home reasonably affordable. And we have highly rated schools. We have a fairly low crime rate. Anywhere that you have a large population, there's going to be crime. But yeah, both of those are definitely good cities to look at if you're looking to relocate anywhere in Southern California. Charles Boswell says, what is your opinion on solar? Neither Jeb nor I are huge fans of solar, but it depends largely on where you are. I have a place out in I almost said Rancho Cucamonga, Rancho Mirage, anywhere in the desert, anywhere Victorville, the high desert. If you're in Texas, Arizona, some of these places, your heating and cooling bills specifically in the summer, are so high that it easily pays for itself. I'm going to pull it up here real quick while we're talking. I think it is Google Project Solar. What the heck is it? Project Sunroof. So sunroof.withgoogle.com. You can plug in your address. You want to go back and actually look up your utility bills and plug those in, and it will tell you what size of installation you need, give you a range of what it's likely to cost, what the recoup period is on it, and whether you're better off with a power purchase agreement, leasing, or purchasing outright your solar. So it can absolutely be justified in some of these hot areas. For us here in Huntington Beach, right along the coast, it doesn't get that hot. We use our AC for about 3 months out of the year. Most people don't have AC. I have a dark pool, so my pool stays warm. I don't have big expenses for that. So I'm not a big, huge fan of it, but I certainly understand why it can be good in a lot of areas. Got a good one here. House Hacker 619. It's for a friend. What's the current VA rate and which lender offers the lowest rate? You're going to go back and start by saying you do not want the absolute lowest rate. It's like the cheapest provider of anything. It's going to be cut rate, low service. You're not getting expertise. There is a certain margin that you need to be able to provide service levels, knowledge, expertise versus a giant call center that's just kill them all, let God sort them out. Whatever we can put through, we'll put them through at tiny margins. You want an awesome competitive rate. So as of today, for a very well qualified VA borrower, it's going to be in the low sixes. It's going to depend. Do we want to pay points? Do we not want to pay points? When you call up and you ask a giant national lender like Rocket, Veterans United, any of these big call center lenders, and you say, what's my absolute lowest rate? They're going to quote you 2.5 points to buy that rate down. On a VA loan, you don't have to make a down payment. So most of my VA borrowers don't want to put a 1 point, 2 point, 3 points down to get the absolute lowest rate. So VA, FHA are better than conventional. VA is awesome in that it has no monthly mortgage insurance premium. You'll pay that funding fee unless you're funding fee exempt. But we do a lot of VA loans. My preferred loan, if I could do nothing but VA loans, sorry to the rest of you non-veterans, I would be happy to just serve veterans because that loan program is so awesome, so flexible, so good. And it's my ability to give back to veterans who gave to our country in a way that I wasn't able to. So House Hacker 619, again, about 18 states, we can help you. Use that link below. We can get a detailed quote, put that in writing. We never lose a deal to any of the big national lenders, any of the big credit unions that help purport to help and cater to veterans. So I'd love to help you with that. Smart Fox says, can I keep my rental in California, move from California, and make Las Vegas my domicile for no state income tax? Would California come after me and make me pay more taxes? I hit the like button. Well, thank you. I appreciate you hitting the like button. I'm not a tax expert. If you do not live in California, you should not have to pay California income tax. But what I can say, if I leave California and I keep my business located here, I'm not the best example because it's a service-related business. I could literally pick up everything and move it. But let's say I had a store. Jeb, as a client right now, owns a restaurant here in Long Beach and is moving to Texas. Some of his income will be shielded, but my understanding is that when you have a business that generates your income that is located in California, they're going to get their hands into some of your income. But the situation you're describing, my understanding is you absolutely could do that and avoid the state income tax. So hopefully that's the answer you were looking for, but absolutely check with a tax provider. And if you need a referral on that, we have a good one that Jeb and I know as well that can help you. Deerfield Disc Golf. By the way, in my YouTube feed, I came across something wild the other day. This guy, the Texas State Disc Golf Championship, this guy was like 16 under par. I say guy, he's like 23, 24 years old. I have never seen a man throw a Frisbee like this. He could throw it overhand, underhand, whip it sidearm, through little gaps in the trees. I've seen disc golf before. I know these guys can throw them a long ways. I've never seen anything like this. The kid was 16 under and won the Texas State Championship. So Deerfield Disc Golf, you may know the kid I'm talking about. I have $130,000 and about to buy a house for $240,000, income of $60,000 annually. Is it better to just make the 20% down payment or put maybe 30 to 40% down to get a lower monthly? It depends on what you're going to do with the money. If you're just going to put it into a high yield savings account, right now you can get 5% on it. That's great, but you're going to pay more than that on the mortgage, and you're going to get taxed on that 5%. If it's in a tax deferred account, a 401k, if you can put it to an IRA, something that would be tax advantaged and can grow at a 7, 8, 9, 10% long-term rate, I would think more in terms of letting it run. So think in terms of what you're going to do with the money. I would think in terms of doing 25, 30% down will get you to the best terms. The absolute best terms are at 40% or more down. But if you have an excellent credit score, which that with your amount of savings, I'm hoping that you do, planning and believing that you do. But with that, look at 25, maybe 30% down and stay liquid. I don't like people tying all their money into their house. You need to be comfortable with that payment, but we also need to be liquid and be able to save and invest in other routes. Remember, there's more than one way to mortgage freedom. One is, hey, I put the biggest down payment, take the shortest loan, put every extra dollar I have towards paying off my mortgage. But then we get over invested in a fairly illiquid asset like real estate. There's a balance there of wanting to maximize out all of your other accounts. If you put, well, we got 130,000 on that 240 purchase, 30% down is only 72. So you're still going to have, after closing costs, 50 grand. It's probably a good balance there for you without seeing and knowing your situation. But put that 50,000 away. Rule of 72 at 8%, it's going to double in 9 years. So it goes from 50 to 100. In another 9 years, it goes from 100 to 200. And during that time, the $180,000 mortgage, you can get paid down to 130, 140. So you can be mortgage free with the amount of money that you have in 15 years or less. So that is what you want to be looking at. And that is really an important question for you to go through with the mortgage advisor you're dealing with. And if they don't know how to advise you, or they tell you, it's not really my deal, I just deal with how to structure the loan, get with someone who can go through those numbers. We are a financial advisor that works on the liability side of your balance sheet. Yes, the house is an asset, but the mortgage is a liability. We're looking at all of your other liabilities. We're uniquely positioned to be able to advise you in that regard. Patrick, another regular viewer, says, if buyers, realtors are now adopting compensation contracts for services, what are your thoughts regarding optimization, especially if my agent sucks? Fire them. Do not work with someone that sucks. Do a better job of vetting them up front. Use the link below to get a referral from Jeb and his network. But seriously, interview a couple of people and look at multiple pieces of it. If we get later in the year, in the next 2 years, in the next 5 years, there's a situation where buyers end up paying for their own representation, it's going to be tantalizing to look and say, I will just take whoever will do it the lowest. 1%, cool. I'm gonna pay this person 1% and they're gonna represent me. This is a skilled negotiation position. There's people skills, negotiating skills, transaction management skills that you want to make sure, much like on the mortgage side, you have someone that has knowledge and experience, expertise, and also just connects with you so that you can tell them what you want and communicate well. If they suck, really, it should be as easy as firing. So when you're looking at that buyer's broker agreement, you want to make sure it's not exclusive and it doesn't lock you in for any specific period of time. They're going to want to know that when they're representing you and showing you houses, that when you find a house, we've already agreed this is my compensation. So it's reasonable for them to want that buyer broker agreement, but to have it exclusive or exclusive for a long period of time, you shouldn't need to do that. So from that end, well, let's look at this. Rickless Cage back with, how likely is it that a mortgage broker will find a buyer a rate better than the par rate without having to pay for points? There is not a par rate that every lender has. So the benefit to a broker, I have 70 lenders that we can look at. And for a well-qualified borrower, any borrower, when we're looking at that, I can tell you there are lenders that literally cater to, on the FHA side, that 620 to 640 credit score borrower. So if I have someone and they tell me, hey, my credit score is 685, I'm looking, my top 5 lenders are probably going to look different than if I pull their credit and it's 640. So that par rate of not having to pay any points, it's different across those 70. Now, if you are going to a direct lender, a mortgage bank, so this isn't to bash on anyone, but say a guaranteed rate. Guaranteed rate is a big direct lender mortgage bank. They don't have 70 investors. They have 3, 5, 7, 10. I don't know how many, but they have less than we do. And that's for a reason. Their business model is set up for scale. They need to be able to deliver a volume of business efficiently to those investors that are buying loans from them. So we end up having more options than they do. There's pluses and minuses to each side. You could get a good loan from either channel. So the question again is, can you get a better rate than the par rate? So It's not, because that is the par rate. So if I say, hey, I ran through all 70 of my best price lenders, or all of my lenders, and here's one or two. There's always one or two that are fly by night places. I was looking at with one of my account executives. He said, hey, we're number 2 in Loan Sifter on this product today. I said, cool. Who's number 1? Some crazy lender I've never heard of. And like not even, oh, I don't really know who they are. I've never even heard of them. We wouldn't send your loan there. I mean, if they were offering 2% lower interest rate and we could call them and get a really solid feeling for it, maybe, possibly, but realistically, we're not going to do that. We're going to go and say who has the best terms, the best system, the best technology, and the ability that if we get into something sticky, we can get some help. What does help look like? I have a borrower that got an offer accepted last Wednesday. We had told them, yeah, if you absolutely positively have to do this, we can do 7-day contingency on the loan and on the appraisal. Well, sure enough, they do it Wednesday night, with Monday being a holiday. So on Thursday, I got the contract. So we get started on Thursday. We have most of the day Thursday, all of the day Friday, and about 2 hours into Tuesday, the first day of the week, I get a call from them, and not from them, from their agent, saying, hey, are we gonna be able to clear that loan approval and appraisal contingency tomorrow? And I said, we've had it for 2.5 days. I'm not sure how you would expect us to be able to do that. But we were able to call the lender and say, hey, we do a lot of business with you. Can we move that one to the front of the line? And we will have the approval tomorrow morning. So 8 hours beyond what was expected. So those are the things there that we want to have flexibility, someone that's going to work with us to be able to deliver those service levels. But again, I will go back. I know you guys all want an awesome interest rate, and you want to brag that I have the lowest interest rates. There's a couple things. 2 months down the line, you're not going to remember what your interest rate is. So you want a competitive rate. You don't want to overpay for anything. But in terms of that, the question here, Nicholas, may have been just to say, is a broker really a good option? Is it going to get me a better term? We are almost always going to get you a better rate than a bank, a mortgage bank, credit union. Now, I can't say that blanket across the board, because I will always get a call and someone will say, well, I saw my credit union. Who are they? Most credit unions are glorified mortgage brokers. They're not closing the loan, so they're not optimized. But some of the big credit unions do lend their own money, and some of them can get very aggressive on their pricing at times. So there's no blanket statement of what is the best channel for you to get your loan. You can get a good loan from all of them. You want to check with 2, 3, not 5, 6, 7 lenders, because that will just confuse the heck out of you, but 2 or 3 different lenders across multiple channels. See who has competitive pricing. So where the market is, compare that to Mortgage News Daily, and then go with the person that you feel understands, gets you, and has the knowledge and expertise that you need. So let's look here. What do we got? This is an interesting question and a fairly quick answer. Alvin Singh says, hi guys, do you think it'll be cheaper to build a house from the ground up? Is there a land loan and construction loan? Is it easy to get those? What do I need for those loans? No, it will not be easier. We had this question a ton during COVID when there was bidding wars, entry-level buyers were having to fight against 30, 40, 50 people. Building a house is not an easy process. Yes, there are loans for them. We can do one-time close construction loans with almost any type of loan program, an underlying FHA, VA, conventional USDA. They all offer them. Very few lenders offer them for USDA, very few for FHA, very few for VA, but they're out there. You can do them. But what I would say is you are becoming the builder in this process. If you're a first-time buyer, you've never renovated a home. If you've been through a renovation, most people, the hair is standing on end by the time they're done. They're stressed. They'll say, I'm never doing this again. Now imagine going out, finding land, making every selection, picking a home plan, picking a builder, picking all the finishes. I just don't recommend it for most people unless you know yourself really well, that you're a great project manager, you like doing all those things, you have a wonderful design sense. The programs are definitely out there. If you'd like to talk about it, if you're in one of the states that we help, use the referral link below. Jeb will get you connected with me and we'll go from there. So you're in Sacramento, so we can absolutely help you with that. Use that referral link or just shoot an email to info@theeducatedhomebuyer.com. That goes to Jeb and I, and we can start talking about that. So JC Ortiz says homeowners insurance that will work for Riverside, California. Everywhere in California is getting more difficult. So I will tell everyone, I'm not going to give you one referral. I'm going to give you 2 or 3, and I recommend you call all of them and compare what they can do. The broker that I've used forever and I've had no need to change away from because all my policies are great. Last client I referred over to him, they weren't competitive, and he had literally one option. And he told me that. He goes, you could try this, you can try this. So again, that same email, info@theeducatedhomebuyer.com. Or you can go out to the educatedhomebuyer.com and shoot an email directly through, and it'll get to Jeb and I, and we'll get you connected. So Luis, very good question. Have you ever, or how often do you see VA loans, 0 down, 800,000 plus? Does this fly with lenders? Absolutely. After the Blue Water Navy Act, I want to say it was 2020, it might've been 2021. There is no VA loan limit. They will do a 0 down loan to any amount that you can find a lender willing to do it. Almost all lenders will let you go up to 1.5 million, the vast majority to 2 to 2.5 million. And I think the highest we have of our investors will do about 4 million with 0 down. Some of them have overlays. They shouldn't have overlays for anything under 2 million. 800,000 is standard run of the mill fare. Most of our California buyers, veteran buyers, are doing 0 down, and they're doing 7, 8, 900, $1 million. Did a purchase close just 2 weeks ago for a veteran here in Orange County, $1,350,000. He did have a down payment, but the down payment was only required because he was not selling his departing residence. He was doing a secondary entitlement. So House Hacker says he'll tell his buddy that we can help him on the VA. Don't sell says, what's up, Josh? Just here talking. And you guys wouldn't think that talking is tiring, but 40 minutes without anyone else to talk and go back and forth with. Definitely more fun with the co-host. We're going to tell him to not leave as often anymore or anytime soon. So Josh, another regular viewer, I'm currently pre-approved for 1.4, but houses in the area I'm looking at are going for 1.5 to 1.7. Is it futile to save 80 to 100,000 a year and maybe hope home prices don't shoot up higher? I'm tempted to say yes, that it is futile. It's not impossible. We don't have, a crystal ball. We've seen very respected analysts thinking that appreciation will tail off later this year. We're hoping that it will tail off. I don't want to see any more 6, 7, 8% appreciation. If we could get that in the 2 to 3% range for a couple of years, it would do well for everyone. Perfect world would be we settle into 2 to 3% for the next 5 years, and interest rates drop from the 7% range down to the 5% range, and most of you guys would be in a good spot. But we don't know that that's going to happen. We think interest rates are going to come down. We think home price inflation is going to moderate, but no guarantees on that, especially if you're here in California where we have limited amount of space. So from that perspective, if you're truly capped at 1.4 and don't have a way to get beyond that, it's just hard to say. Because if we're looking, again, let's say that I'm right, or that guess or my wish is granted, and we only get 3% inflation in home prices at 1.4, you're still talking $42,000 more next year. So you saved 80, but the price went up $40,000. Now, hopefully the rates come down, but that may mean the prices go up 5, 6, 7%. Very difficult one to answer there. So hopefully that was helpful in some way. So Marcus Doswell, it's almost like a leading question. It's almost like we planted him here. It says, when is the next video on your channel, Josh? Really enjoy the content. Talking about my personal channel, you guys know on the podcast channel, The Educated Homebuyer, we do a new video every Tuesday. I believe what we have coming out next week, boy, we did it. We recorded several of them here recently. The one today that we recorded that will be out in 2 weeks was the 5 biggest mistakes that mortgage borrowers are making when buying a home in 2024. What did we cover? It was 5 different mistakes. 5 mistakes when refinancing. Again, with rates not cooperating and not ticking down a little bit, we don't have a lot of refinance activity, but a really, really good episode on how to refinance without putting yourself in an even worse situation, which most loan officers will try and put you into. So I recommend checking both those out. But Marcus is talking about my personal channel. We are working really hard on getting me a workflow where I can get 1 video out a week. If you guys have any thoughts on what day is the best for you, we've experimented around. I think Jeb drops his weekly videos on the Jeb Smith YouTube channel on Mondays. He's doing 1 a week. We're going to try and get to 1 a week and maybe do a few clips of some of these questions that are answered and build out a library of questions. So if you're interested, my channel is youtube.com @JoshLewisCMC for certified mortgage consultant. Check it out. We are going to ramp back up with the content. In another 2 weeks, we will start back up with Vetted VA Live that streams both on the Vetted VA channel and on my channel every Tuesday night from 5 to 6, where we get a panel of VA experts and talk about everything a veteran borrower needs to know. And to me, again, I already told you guys earlier, I love the VA loan. I love helping veterans. I don't know that there is a group that gets more disinformation, bad information, treated more poorly relative to what they should get. So if you want to educate yourself on the program, if you have questions, you're a veteran, you're VA eligible, show up Monday or Tuesday from 5 to 6. We have a great team of experts around the country, both real estate and mortgage, that can answer all your questions. Jonathan has a question. Inspection was completed today, but home wasn't 100% finished. HVAC and garbage disposal not wired. Floor still covered with cardboard. Would you have another inspection before the blue tape walk? I would absolutely have another inspection. Again, I'm not handy. I am like the least handy person in the world. I have design sense, but I have no handy skills. So from that perspective, I want someone to come through, do that walkthrough, check everything out. So hopefully you could get a discounted rate for a quick sort of touch up on that inspection from the person that you had used from that perspective. So hopefully that helps. Infinity back. My son wants to purchase a home next year. Once he starts looking for a lender, I mentioned to look for about 3 and do it within 1 week so he won't get dinged. Do you recommend that? You have a 45-day window to have your credit report pulled by as many mortgage lenders as you want. Wouldn't recommend doing it on day 1 and day 45. Let's try and keep it within a 30-day window. In talking to different lenders, you shouldn't need to have 3 pull your credit report. Make the phone call. Tell them, hey, per Credit Karma, per Experian, per my Visa credit card, my credit score is 720. I have X number of dollars to deal with. This is what I would like to buy. And we talk about the difference between pre-qualification and pre-approval. This, if you're trying to decide who you want to work with, you say, hey, I'd like to go through a quick pre-qualification. Let me know if I am in the ballpark for what I want to buy. We did this for a listener today, reaches out and says, is this crazy? Am I nuts to even look at this? I don't want to pull my credit if I can't do this. We go through the numbers and we're like, brother, you have 0 worries. We can absolutely get you approved. So that is a position where is a reasonable thing to do. So talk to a couple lenders. Am I in the ballpark? Cool, I'm in the ballpark. If what I told you is correct and true, and I should be doing an FHA loan with a 720 credit score, what would the terms look like today? And at that point, you can decide, who am I going to complete the application with? Who am I going to lock an interest rate with? Who is going to pull my credit? You don't need to go all the way down that path and do a full pre-approval with 3 different people. You need to, again, find someone that has competitive rates, knowledge and expertise, and that you connect with. All 3 of those are equally important. So I probably sound like a broken record. It's like the 4th time in the 45 minutes that we've been on here that I've said this. Please don't call and ask, what is your absolute rock bottom lowest interest rate? And please, if you talk to 3 people and they're all within 1/8%, unless the one that is the cheapest is the one that you think is the best connection with you and the best knowledge and expertise, I assure you, 90 days after you close, you are not going to remember what your interest rate is. You're not going to brag about it at the neighborhood barbecue. You want a competitive interest rate. You want low fees, but you want to have a good, solid experience. I have 2 files right now that we're knee deep in trying to unwind what some knucklehead loan officer did because they didn't want to do the hard work up front. Hopefully you're super well qualified and your file is easy. But I'm going to say in this market, 40, 50, 60% of them aren't. And we have to look around corners. We have to predict what that underwriter is going to want to see and get ahead of the game. So from that perspective, that's my 2 cents on that. Here we go. House Hacker 619. Same friend, and he finds an assumable VA loan. Can he take another loan to pay the difference? Yes, my understanding is the other loan has to also be an assumable loan, which can be difficult in terms of finding a second mortgage. The interesting part is if you assume someone else's VA mortgage, there's no loan officer involved. So you're going to kind of be on your own. The realtors might be able to help, but that's not their area of expertise or specialty either. So from that perspective, that's what you're looking at. Is it going to be a personal loan? Probably not, depending on how much you need. You know, I talked to a gentleman down in San Diego here, and he wanted to sell his condo and assume another condo, and he was going to be about 50 grand short. And he's like, no, I'm not doing a personal loan. It's going to be 10, 12, 15%. You can get a better interest rate on a secured second mortgage. Ooh, interesting question here. Don't Sell says, I'm scheduled to complete my attached 490 square foot ADU by the end of the month, Both my 3-bedroom, 2-bath, and my ADU are vacant. Do I qualify for HELOC or second loan if they are vacant? The fact that they're vacant doesn't preclude you from getting the financing. If we need the income to qualify, we're probably going to need to get them leased out. It's going to depend on what type of loan program you're doing and exactly how that looks. So again, if you're in an area where we can help, reach out. If you're not, we can get you connected with someone else, but that is a unique situation there. Vince follows up and says, I have the exact same question as Luis Perez regarding the 800,000 zero down loan. 1,000%. Again, most of my buyers in California, most of my veteran buyers, that's the price range they're at. It just that's the reality of at least Southern California. You get to the Central Valley, maybe a little bit of the Inland Empire. You get way north in California, we have lower prices, but that is common, not difficult. Nothing different about it at all. We have plenty of investors with no overlays. So absolutely reach out if you want to get pre-approved. Use that link. You get connected. You can also use the email info@theeducatedhomebuyer, and we'll go from there. Omar says, what loans are available if I want to build a home on my land? All of your construction products, all the one-time close, FHA, conventional, USDA if you're in a rural area. And if you own the land, your equity, well, either way, if you own the land or it's financed, your equity in the land can be used as your contribution, your down payment to that process. If you're somewhere where we can help, definitely reach out. Would love to work with you on it. Moneybags, this is a difficult one. Do we see softening in prices in SoCal in the coming months, or do you anticipate more moderate appreciation throughout the 2024 year? We did an episode about 2-3 months ago on the podcast that not just in Southern California, but nationwide, most of the appreciation in any given calendar year happens between April and August. So we're to the far end of that already here in May. The contracts that go, the homes that go under contract by the end of June are the ones that close by the end of August. Again, it's that same time frame of people wanting to get moved over the summer, get their kids in school before the new school year starts. So there are things telling us that we should see moderation, and then we have the normal seasonal moderation. So my hope and expectation is, yes, we should have a slowing of appreciation the rest of the year, but we've been surprised to the upside both of the last 2 years. So I wouldn't count on it, but hopeful that, yeah, we'll see a lower rate of appreciation the rest of the year. So Noah 64 says, how does going over the asking price on a house affect your loan? If I get a house for 10K over, can I pay the difference in cash, or does it all go towards the loan? The important part here is the appraisal. If the appraisal comes in at 10,000 over the asking price, you don't have to do anything. You just make your normal down payment. Let's say if the house was offered at 500, you paid 510 and it appraises at 500, the loan to value is going to be calculated off of the $500,000, not the 510, because it only appraised for 500. It's the lesser of the sale price, 510, or the appraised value, 500. So in that instance, let's say you were putting 20% down. So you're getting a $400,000 loan, but it didn't appraise. So I threw my numbers off there, but you see where I'm going with that. If it comes in $10,000 low, you don't have to put any more down, but you're no longer putting 20% down. So you'll have some mortgage insurance there. I have this situation with a listener to the show right now. They ended up selling their properties. They make a huge down payment, so it doesn't make a difference. But in your situation, it could absolutely make a difference, but it's going to come down to the appraisal more so than the fact that you paid above the listing price. MQ says, will mortgage interest rates be lower with higher unemployment? That would be the hope. So the question is, it's not even the hope. The Fed has telegraphed it. One of the things they want to see inflation moderating. They want to see unemployment a little bit higher. They don't want to see 5, 6, 7% unemployment, but they don't want to see the labor market as tight as it is right now. So if we get to 4.2, 4.3, 4.4% unemployment, we would likely be in an environment where interest rates are lower. So no guarantees, but that is the expectation by most market participants. Jonathan, what happens to escrow if we give extra payment, recast with a 3-2-1 buy down? So the 3-2-1 buy down is fairly expensive. That's a big chunk of cash. But let's say after the first year, you only have about 2% in there. So again, let's use the example of a $500,000 purchase. After the first year, there's only about $10,000 in that buy down account. I'm not sure that most lenders would do a recast with that small of an extra payment. So I wouldn't count on a recast. If you're doing government loans, you're not going to be able to recast. So it's only possible with a conventional loan, and it's never guaranteed. It is up to the lender if they want to participate. Orange Pulp, there are more homes on the market now than any time since August 2020. Housing Wire, thoughts? What was there to think about? It's a piece of data, and we are coming off of very, very low rates. We showed the chart at the beginning of the show where you can see we are still a good solid 30% below where we were prior to the pandemic. So until we get over 1 million homes listed for sale, which don't really see a path to, Bill McBride, again at Calculated Risk, about a week ago, he did a really good analysis on this. He said, I could paint a picture here where we could get there to 1 million listings on the market in the next 6 months. But it was like 4 things that had to happen, and none of them are necessarily likely, much less all 4 of them. So could it happen? Yeah. The amount of homes on the market does not concern me in any way, shape, or form. We are simply normalizing and hopefully bringing down that rate of inflation. So we're not seeing 6-7% home price appreciation year over year. We get it more into that 2 to 3% range. Interesting one. Real Estate Curious says, why do lenders bump? I don't know what a bump is, so I couldn't help you with that. Rob had a comment here, says, a homeowner, it disgusts me to see annual 6 to 7% appreciation. Well, you are a true altruist, Rob, because most homeowners love it. But I, as a homeowner, and you as a homeowner, can see that it is not healthy for the economy as a whole, not healthy for the younger generations. We need to see that moderate. Patrick says, are under 3% assumable mortgages a thing? What are your thoughts on approaching this method? Very hard to find. Most of them are highly appreciated because they bought early in COVID. So you need to be able to get a second mortgage. And that's going to then involve a blended rate. You have to find the person. You have to be able to find someone that has the loan, is willing to let you assume it. You like the house, and then you're able to cover the gap. We did an entire episode of the podcast on assuming loans and go into it in detail. Check it out. It should give you all the information that you need. Real Estate Curious. I think he hit enter too soon. He confused me, and I think it's just from sending it too fast. Why do lenders bump up the rate if borrowers do not want to set up an escrow account, even with an 847 credit score? Not all do. I would say the vast majority do not. If you're dealing with a lender that does, I would check another source. But what I will say, the ones that are finicky and picky on this are generally the ones that have really, really good terms, and they want their pools of loans as attractive in the secondary market as possible, which can lead to them wanting an escrow impound account. But I check with another lender, because from our end, it does not matter whether you're doing impounds or not with 85-95% of our investors. Rob says that 3% assumable mortgages is a fairy tale. It is not a fairy tale. They do exist, but they are very few and very far between. So a fairy tale is excessive, but I don't know that I would count on going out and finding one and it being a home that I like, and me being able to get it under contract, and me being able to cover that gap. So what do we got here? This is awesome. A borrower, Monica Lines here, says, hi, Josh. Long time no see. Miss watching you guys. Wanted to let you know we got the PMI off of our payment. Thank you for all the help. I know Jeb's done a video on this. I don't know if we've done an episode of the podcast because it's probably not long enough. But we've covered the question and the guidelines here many a time. Once you get to 20% equity in your home, if you have an on-time payment history and a conventional loan, you can petition the lender to get rid of that mortgage insurance. There will be some requirements, some minor fees, but it can be a pretty significant difference. So congratulations, Monica. Thanks for letting us know. So let's look here. All right, we got a VIP viewer here. Kim says, Josh, you've mentioned before that Experian 3 monitoring scoring is an accurate picture of your credit score. Is that still accurate? For me, it's dead on. What I will say, I think all of the monitoring is more accurate the higher your score is. The lower it gets, the more of a disparity we see of any of those third-party services. But what I can tell you with mine, it is dead on. The things I like about it is you can do some what if, some modeling in there saying, what if I pay this off? What if I got my limit increase? And it will tell you what's likely to happen. The Experian, they give you a report every month. So every 30 days, you're seeing exactly what's happening there. And then the other two you get every 90 days. You used to get them every 30 days also. But if you're in the middle of the process, you want to look at it without having a hard inquiry, you can pay to get all 3 bureaus. And mine have been very accurate. And it's surprising the impact, even with a very high credit score, the impact that just little things, bumping up a credit balance over 10% of your available credit, over 30% of your available credit, it will have a big difference, and it comes down very, very quickly as well, or goes back up very quickly once you pay that down. Let's see. Esau has a really good question here, and it's an interesting answer. I have a single family home in California with a conventional loan. If I was looking to purchase a multifamily or mixed use property with an FHA loan, would it be possible with a conventional loan? I plan to own or occupy for a year. So with FHA, it's possible, but they have something called the 100-mile rule. So if you're going to keep the home with the conventional loan on it, if you need to use rents to offset that to qualify for the new purchase, that property needs to be at least 100 miles away if you're using FHA financing, even though that property doesn't have FHA financing on it. It can trip up people. So the interesting thing is, if that doesn't apply, if you're looking at both of them within a 100-mile radius of each other, conventional became an option here in the last year, because if it's going to be owner-occupied units, you can do as little as 5% down. Terms aren't quite as good as what you get on an FHA, but it just opens up that possibility to people who could not do it before. Have you heard of UMortgage? Was recommended someone that is affiliated, but heard some shady stories about the CEO online. I have several friends that work for UMortgage. So UMortgage it's not really a franchise. They are employees. They do work for UMortgage, but people who were independent brokers moved under the UMortgage umbrella. Many of the things that you read about Anthony are true, and he would tell you that they are true. But he's a good businessman. He runs a good operation. The people that I know that are over there are very trustworthy. So if that's a route you want to go, you could do a lot worse. If you still want a connection, let us know. But I don't have any reason to back away from UMortgage. As I said, several of the people who come on to Vetted VA Live are UMortgage lenders, and they know their stuff. They are professionals. They produce at a higher rate. Anthony's not hiring, people that are doing onesie twosie loans. You're going to go and do volume. Before we made our move to move Bywise Mortgage under the United American umbrella, we talked and we looked at UMortgage. I felt this was a better fit for us, better for me economically, better for our borrowers. But UMortgage was absolutely a consideration. Let's see. House Hacker with another question. How low, or what's the point of interest it makes sense to refinance to a lower rate? Let's say if someone has 7%, if that person can refinance to 6%, does it make sense to refinance? You left out the most important part of the equation. How big is their loan? Let's say in your example, that person has a $100,000 loan. Make it easy for me, $125,000 loan. The simple rule of thumb to tell us when it starts to make sense to pencil out the numbers to confirm: take $125,000, divide it by your loan amount. That tells you how much you need to save. So $125,000 divided by $125,000 loan in our example, 1% would be enough. So 1% is going to be enough for most borrowers to make that leap. But let's say you have a $500,000 loan. 125,000 divided by 500,000, you can justify it at 0.25%. I tell people, be careful. You generally are not going to be doing this 2, 3, 4, 5 times in a year. It's kind of a pain in the butt. You don't want to do it all that often. Your lender doesn't want to do it that often for you. So if we catch a good downtrend and the market is moving down, you want to give it some room to run. So for most people, you're going to want to see at least 0.5%, no matter how large your loan is. But if we don't think we're going to have that opportunity, and there's 1/4 to 3/8% and you're early in your loan, it can make sense. What I would absolutely say is check out next Tuesday's episode when it goes live on how to refinance right, because we go through this, we go through how to structure it and how to make sure that you're not just lowering your payment, you're actually improving your financial future when you refinance. We are getting to the end of the questions, and we're at 1 hour and 3 minutes. I've talked myself through a whole hour here. Let's look at this. So Flintlock, I just went through this channel to start the buying process. Jeb recommended a real estate agent too, just closed yesterday, appraised at 235, paid 217 at 5.5%, 30-year fixed. Cannot believe it. So true example there from a realtor that Jeb helped someone connect with. So happy that you guys are all here. Happy that you join us every week. If you're on Jeb's channel, make sure you like the video, get this out to more people. If you're not subscribed, go ahead and subscribe. If you're on the Educated Homebuyer podcast channel and you came across this, you're not subscribed, like and subscribe there. New episodes every week. Jeb has new videos every week. If you're interested, my channel is at Josh Lewis CMC. Had a little unexpected hiatus here, but we'll be back soon with videos every week. If you need a realtor, you need a mortgage professional, we are here to help. Truly an 80-20 business. 80% of the people are not anyone you would want to work with. So good news, the 20%, there's still a lot of mortgage people, a lot of real estate people. What I say is that 80-20 is also fractal. You want someone that's in the top 20% of that top 20%. So you're shooting for a top 4% agent, top 4% mortgage professional. Unfortunately, all day, every day, I get calls and emails from people letting me know how bad most of the loan officers are out there. So if you found an awesome one, fantastic. If you feel like you have doubts and you're in bad hands and you want a second opinion, reach out. We'd love to go through it with you. You can use that referral link. As we said, you can email info@theeducatedhomebuyer.com. But if we don't have any more questions, I thank all of you guys here for showing up and listening to one guy talk for an entire hour. We will have Jeb back next week and we'll go through the data. We'll answer all your questions and help you guys buy right, borrow smart, and build wealth. All right. Adios, amigos.